Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialists, Robson and Ian Vanderhorn. We've had a pretty big data week, I would say, both in the UK and the US. So I think let's start there first with the UK. So, Paul, what did you make of this week's inflation and labour market data as well?
Well, it's certainly an important week in terms of the data, the sort of two big hitting data releases that you look for on the calendar each month, so inflation and the labour market report. In terms of inflation, I think the key takeaway was that inflation in the UK just remains sticky. It was a little bit higher the market expectations, and crucially both on core and services, and both those numbers are going to have to ease over coming months if the Bank of England is going to be able to cut interest rates in coming quarters, which we think there's enough progress, but I think expectations that they can cut more aggressively or to a lower terminal rate are sort of too dovish at the moment. When we think about service sector inflation, that's running at levels that are just inconsistent with price stability and a mandate, given where goods price inflation and food prices are at the moment. So we'll be watching the data really carefully. For me, this week was all about the employment report, labour market data. That was always the case all the way back from when we got the May numbers a month ago. In terms of the latest data, we had a 41,000 decline in payrolls, which sort of matched the market consensus. But it was always going to be about that outsized fall in employment in May, that 109,000 drop, and whether that was going to be revised away. It was interesting in as much as you don't often get a data release where the focus is more on the revision than the actual outturn. These numbers are always provisional and prone to quite sizable revisions, and so for me it was always interesting that people took the decline, the original data at face value. Now this month we actually got quite a significant upward revision in payroll, so the fall is only now 25,000. There were also, importantly, I think, revisions to prior months before that as well. So the labour market data trends are looking quite significantly different and more in line now with some of the survey data that we've had. So the DMP survey, the REC survey, which suggested that labour market trends weren't nearly as worrying as the official data. Another, just quickly, a couple of takeaways for me on the numbers. I think when you look at the survey data and recent trends in the official data, it suggests that we might actually get further upside revisions in coming months, and I think that that's definitely something that we need to look at. For now, the labour market in the UK continues to soften. I think that's reflecting margin pressure that companies aren't able to push through higher prices to consumers and therefore are looking to cut costs, but it's not doing so quickly enough to allow the Bank of England to cut interest rates more quickly.
So how does that leave your Bank of England call then? Are you still expecting 2 more cuts this year?
Yeah, our Bank of England views are unchanged. There's nothing in the report that suggests that we need to think about more aggressive rate cuts from the Bank of England. We've got those 2 rate cuts, as you quite rightly referenced, one in August, so the back end of sort of late summer, and then into November. And crucially, when we look into 2026, we don't think we'll get any additional easing unless the labour market starts to weaken a little bit further. Now, markets are a little bit more dovishly priced, looking for a terminal rate at 340. We've got 375, not a huge amount in it, but I think there's quite a lot of people on the street that are looking for a sharper fall. So this week's data in its entirety, I think just pushes back on some of those bullish front-end rates trades that I think markets are positioned for.
We've obviously not just had monetary policy to talk about in the UK. There's also been some questions on fiscal policy, and it's our first time really catching up since the welfare reform bill. Did that change much for you?
Well, it's certainly a bit of a dicey time for the bond market. I can promise you I wasn't hiding, having seen the price action that we had through the welfare reform bill. I think that the gilt market has traded a little bit more calmly this week. There's been little follow through. I think it's been a beta on global bond market sort of betas, if you like. It's been taking its lead from what's been happening to treasuries in Europe. We've got a spread narrowing actually relative to EGBs as well. So a little bit of calm. And I think that's right, because I think it's important not to overreact to what we saw just over a week ago. We ended up actually with just a modest dilution of fiscal policy. Yes, fiscal policy is probably in an unsustainable position, but that's more about sort of 2 to 3 years out rather than a need for radical action in terms of fiscal policy come the autumn budget. And that's why some people actually think the Bank of England will ultimately cut rates more aggressively, because they think we're going to get this significant tightening in fiscal policy. I don't think that that's the case. Also, in the end, when all said and done, that we didn't get any change in leadership at the Treasury in terms of fiscal policy. And I think that's ultimately important. And I think that also highlights the importance that bond market investors place on the fiscal rules in the UK. So on the reform bill changes, gilts actually held up relatively well. They sold off a little bit, but it was only when you got worries about leadership change that you had that vol event. And I think that will just focus people's attention in government, in Parliament, that they have to tread carefully in terms of fiscal policy. So our views will remain unchanged. We still have 475 as a target for 10-year gilts. I think there's going to be pressure, and I think that we probably haven't seen the highs yet for 10-year yields that we're going to see in 2025. So still a bearish bias.
So I suppose the other question on long end yields is what happens to Bank of England's QT. There's been quite a lot of speeches we've had from Bank of England speakers here. So has that changed anything for you?
It has actually, especially the speech by, or the comments from Bailey. I won't go into too much detail because I think I've already spoken enough here. But we think active sales will come to an end when the MPC makes their quantitative tightening QT decision at the September meeting. In lots of ways, things haven't changed the way they've been thinking about it. They still worry about the interest rate sensitivity of the balance sheet. They still would like to supply reserves via repo rather than directly from the balance sheet. The steady state of reserves is probably at the top end of estimates. There's a wide range of estimates, but even if they continue at 100 billion of asset sales per year, you'd still be at the top of that range. And of course, they want to keep fiscal policy and monetary policy separate. They've been very clear about this, and independence of the Bank of England. But it was those Bailey's comments, and previously he talked about the decision being live and more interesting. In his latest comments, he talked about illiquid bond markets at the long end, taking into account the impact on long end yields. And this just plays this idea that demand for long end bonds is shifting. It's clear the DMO knows about it, the Treasury knows about it, and the Bank of England knows about it. So it's a change of view. We for a long time thought active sales would continue, but we think that that will come to an end.
Great, thanks, Paul. Quite a lot going on in the UK. So I think let's move on to the US now and talk a little bit about the US CPI print. So Ian, what did we learn from the CPI print for this week, and what does that mean for Fed policy?
Sure, thank you, Joann. So Paul described inflation in the UK as being sticky. And I think that's probably a fair way to look at it in the US as well. This week we had CPI. It did edge up on the headline measure to 2.7%, and the core measure also edged up to 2.9%. In both cases, this was broadly in line with expectations. Markets were looking for a small bump in each, due mostly to inadvantageous base effects. But with expectations already set for this to be a trend-like reading, I think the more important part of this week's inflation report is if there was going to be signs that tariffs were feeding through into prices and boosting inflation. And indeed, we actually did see some of that this week. We did see a little bit of tariff pass-through when it comes to core goods, especially a few key categories that are more import dependent, like household furnishings, recreational items. If we actually strip out a decrease in automotives, the monthly gain in core goods, excluding cars, was the largest gain that we've seen in over 3 years. So on net, I think markets were looking for signs of tariffs, and on balance, this report had some of that. I think the question from here now goes, if this is going to continue through the summer, if we're going to continue to see tariff-based inflation feed through into prices. As far as our view, we actually think that we will continue to see this. President Trump has pushed out the reciprocal tariff deadline. It was in July, now it's in August. We have seen a couple of deals made in the meantime, but in most cases, effective tariff rates have actually ended up being higher. So take these two things together, we have a longer horizon of uncertainty, and we have ultimately tariffs that are landing at a higher level. We think that the tariff impact will continue to build through the second half of the year. And our U.S. economics team actually sees core inflation ending December at around 3.5%. So we do see a somewhat meaningful pickup through the second half. And you asked about Fed policy. So we think that all signs this week, both from inflation and including a strong retail sales report today, point to the Fed being on hold. As far as a team, we still expect the Fed will be sidelined for the full year. Markets still see about 25 basis points cut over 2 meetings at the end of the year, so 50 basis points total. So we think more can be removed from markets, and we think that that should weigh on the front end of the Treasury curve. So we're still looking for 2-year yields to rise a little bit and settle around 4%. We actually think we would probably already be there if it wasn't from some political pressure being applied to the Fed, and especially Fed Chair Powell in recent weeks and months.
So you obviously mentioned pressure on Powell, and we saw a little bit of that this week as well, with Trump really threatening to fire Powell to some extent. What happened there, and what are you thinking about when it comes to the dynamic between Trump and Fed Chair Powell?
Sure, yeah, this isn't really a new theme per se, but markets were given a little bit of whiplash around it this week. Yesterday, there were reports that surfaced that President Trump would be firing Powell imminently. It didn't take very long for him to sort of shoot down that idea. He was asked in a media interview if that was true, and he said it was not. He said firing Powell was not in the future. But when it was reported, we did see front-end treasuries rally pretty strong, and we did see the long end of the treasury curve sell off. So I just want to flag this price action because I think that's what's notable as we think about this whole situation. It's really emblematic of the market consequence of firing Powell, which really would lead to a further degradation of Fed independence. When you see price action like that, where you have the long end selling off, it's really a signal from the markets that this would not be a good thing, that they would not look upon it positively. Long end treasuries would sell off to account for essentially higher expected inflation that comes with a Fed that's a little bit less tied to its inflation mandate. And that actually feels right to us, because when you have a Fed that's less tied to its inflation mandate and a little bit more willing to pursue, call it, expansionary policy, meanwhile, you have a fiscal authority who's also doing the same thing. We just saw the One Big Beautiful Bill passed, and that's potentially going to add $3.4 trillion to the U.S. deficit. So it's only natural that long end of the Treasury curve would rise as term premiums rise, just to ensure that investors don't see their returns inflated away. But thinking about this over the longer term, I do think Trump knows this. I do think his advisors know this as well. So we continue to feel like there's a low probability that Trump will actually go through with it and fire Powell. In essence, it could at least have a adverse effect for what he's looking for. You would see short end yields lower, but you would actually potentially raise longer term borrowing costs. And that's not what they're looking for. But nonetheless, I do think this is a theme that's probably going to stick around indefinitely. Trump is using it as a way to essentially talk down interest rates in the meantime while the Fed is clearly on hold. It's really his only card that he can play in terms of monetary policy during this campaign of max stimulus. There's also this element, and we think it's true, of wanting to keep Powell around to have somebody to blame should the economy go south. So to wrap this all up, because I've already gone on for a little bit, we don't necessarily think that Trump will actually go through with firing Powell. We think that him backing off the threat to do so was the right move for markets, but we do continue to think that this will hang around, at least in the medium term. So, Joann, let's switch over to you because we have the ECB meeting coming up next week. Is this just going to be a see you after the summer type of meeting?
Yeah, so I definitely think that see you after the summer will be the tagline for the ECB meeting this week, or next week rather. The market is essentially pricing in no cuts next week. Around 1 basis point is being priced, or if actually probably much less than that at this point. So there's really no expectation of cuts to come next week. I do think that this September and December meeting decisions will be much more interesting, and the market is pricing in one more 25 basis point cut through this year. But I think in terms of the message we get next week, it's really not going to be adding too much. Firstly, the trade war, the trade uncertainty at this point is still pretty high. We don't really have resolution on what trade will look like between the US and the EU at this stage. So I think that uncertainty will continue to remain pretty elevated. And that doesn't really give the ECB much to go on, really, to give a more solid set of projections or expectations for what their projections will be in September. So I think the narrative will really be similar to what we've seen in the past, which is essentially inflation normalizing, and I think growth, whilst there are risks to the downside, of course, from the trade uncertainty, there's obviously positives in the pipeline. Our own view is that we do only see ECB terminal rates at 2%, and that's our view that we've had for a very, very long time now, and there really isn't much reason to change that at this point. We think that actually what we could see in terms of growth in Europe is a much more positive story than is expected at the moment. So we do see that the fiscal lever will actually mean that we see a better picture for growth in Europe over the next year and into 2026. And I think that that's a narrative that is perhaps not being considered as much by the market. So we think that 2% as a baseline does continue to make sense. And it will be September and December where the meeting is perhaps more live and the decision a bit more interesting as well.
Thank you. Yeah, that makes sense. So what risks are you watching for next week in Euro rates?
So I think the quiet summer has been quite clear when I'm thinking about European rates markets. It's been the rest of the world, I think, that's been driving European rates in the last couple of weeks, more than anything European specific. So here I take the UK with the fiscal reform, and the Japanese market as well when it comes to Japanese politics, and of course the US. So I think for me, the thing that I am watching over the weekend is the Japanese election of the upper house. I think that obviously there's clear risks to fiscal expansion in Japan that could come if there is a significant defeat for the current coalition and current government. And I think that could drive a bit of a underperformance in rates next week, and rates really selling off because of that. There's obviously a lot of uncertainty around what that election outlook will look like, and perhaps positive noises from trade negotiations between Japan and the US could help the current government. But I do think that from what we're seeing in markets, that fiscal story in Japan clearly does bring upside risks. And if the current coalition government does underperform significantly in the upper house elections, that could mean that they have to start a coalition with a much more fiscally expansive party, and that clearly brings with it fiscal risks and upside risks to yields in Japan. There's also a long-term government bond option in Japan next week, and I think that that is something to look out for. It's something that has meant rates have sold off in Japan because there's just been weakness there structurally and a lack of demand for the long end, particularly given market volatility and shifting demand for long end bonds. So I think that those two things are important for me to watch over the weekend and into next week that are clearly not European factors, but clearly matter for the beta that Europe is trading with versus the rest of the world. But I'll stop here. Thank you everyone for joining me today, and thank you to our listeners for listening. If you did like today's episode, don't forget to like and subscribe. Speak next week.